So right now I could refinance and save $550 a month.
Yeah, let's do it.
Yeah.
I don't know what else you want.
Yeah, we're done. Let's go. Yeah, and that's potentially, that's what you could do, and that's what you have to ask yourself, right? So we do all this math, and we talk about all that.
What should I be asking myself? Because that seems pretty awesome.
What's your end goal in life?
Right. Yeah. Where am I going?
Yeah.
Those are Ben questions. All right, guys. Welcome to the Buff Show. Today we have another podcast coming your way. What do we got, Ben?
I have no clue. I'm just here. We have a lender here.
You're a co-host.
Am I co-hosting?
Yeah.
Okay, so we have a podcast today. And Shelby, will you tell us what it's all about?
I sure will. We're going to be
So-
talking about refinances today.
The whens, who's, what's, and whys?
Exactly.
This is selfishly on my end because I bought a house. It's been a year and a half ago. And my rate is 7.125%. Oh, sorry.
That's rough. That's how he feels about it.
Yeah.
Yeah.
That's
how I feel about it.
And you haven't refinanced yet?
No, I haven't refinanced. That's
Hey,
why we're doing
rates
this.
just hit a 3-year low. It's a good thing you didn't refinance.
Yes, that's true. I'm sorry.
Yeah.
That's why we're having Shelby come on, because everybody that's bought a house in the past 12 to 24 months is dealing with the same thing I'm dealing with. We're not lucky like you with your what?
I just can't afford to buy a house is why.
3% interest rate on your Morgan house.
I think all of my houses are in the 2s minus my personal.
Jeez.
Yeah, that's pretty neat.
That's crazy.
good.
So I guess Shelby, thank you for coming on. You've been on a few times and you're awesome.
Thanks.
So thank you. Tell us who you're with and I guess where rates are right now.
Yeah, for sure. I'm the mortgage manager at First Community Bank. It's a great time. Love it. Been doing it for coming up on 5 years now. It's a good time. And rates right now for a refinance, I mean, we're getting potentially into the 5s depending on how much
Really?
you want to pay for it.
Wow.
Yeah.
That's crazy.
Something we're going to talk about today, right? Is all that rate media and everyone putting things out there, and all of it could be true, but how much do you want to pay for it, and is it actually worth it for your situation?
Yeah.
But I'd say generally, with like a no cost rate right now, you're going to be in the high 5s to low 6s, which is great compared to your 7.125.
What's your prediction? Like, where do you think rates will go as we lead into this year? I know that's a huge question, but we're January of 2026 right now.
Yeah.
What's your thoughts on like
Our
where we'll
average
be?
rate.
Yeah, our
come the
average
end of
rate.
the year.
Yeah. I think from what we've heard from the Mortgage Bankers Association, the MBA releases reports quarterly. Sometimes there's updates other places like Redfin and all those other places you can look. But they're really just projecting by the end of the year for rates to only drop by 1/8 to 1/4. So pretty steady. But I don't think anyone was expecting what happened a few weeks ago.
Yeah.
Yeah, because all of that media with Trump saying that he's going to demand that all these people buy that $200 billion in bonds, right?
Mm-hmm.
So little things like that, all the forecasts and everything, you could, no matter who says what, because that projection was supposed to go all the way to the end of 2027 of rates dropping maybe 1/4% to, 0.375 by the end of 2027. But they dropped close to 0.5% a few weeks ago.
Wow.
So I think just, take those forecasts with a grain of salt, and that's all just projected on what the Feds do. And our rates don't directly correlate with the Fed rates, right? But we also go off of the economy. The job reports every first Friday of the month is a big indicator for rates.
Mm-hmm.
So just watching the economy and what job reports are doing, and little news things like that.
So you say first Friday of the month. What report comes out, or what are we basing that off?
Yeah, it's the economic forecast of the job reports. So how many losses there are, or how many people, as far as openings to fillings. That's kind of what they look for. We want it to be as crappy as possible for rates to do good.
So more unemployment, the better.
That
the
is
interest rate.
correct.
Okay.
Yeah.
So
yeah.
watching the unemployment rates is
Yes, every first Friday of the month they release that. Yep.
That's crazy.
Yeah, it is for sure.
So what have you been seeing on the refinance side right now? Have you been seeing a lot of refinances happen or a lot of talk about it? What have you been experiencing as of lately?
Well, when all that media came out of all the rates dropping, I think that day alone, I probably sent close to 15 quotes.
Oh, wow.
People reaching out and getting
Jeez.
excited, which was awesome. But after calculating the break-even points and how much their rate was changing, a lot of these people were in the high 6s, so to get them in the 5s or even the low 6s, and then the cost to do so and what they're saving on their payment, a lot of people are like, that's good, and I just might, but I want to wait and see. Because you pull the trigger now, even if you're not paying for a rate, you're still paying for the new title, right? You're still paying for possibly a new appraisal. You're paying for a lot of other fees that could come to $5,000 just right there in closing costs, right? Or more, depending on your loan size. So a lot of people are like, it's looking good, but maybe I could do more if I wait.
Yeah, it's looking better.
So when you're talking you used to call it the break-even rate, what numbers come into effect on that? So obviously closing costs, PMI, like what all do you calculate into that to find someone's break-even rate?
Yeah, you could add in the closing costs for sure. I usually start with the difference in your monthly payment.
Okay, that's the big one.
Exactly, because if you roll in your closing costs to your loan amount, the difference in your monthly payment's there anyway. So yes, closing costs, yes, interest rate, total monthly payment difference of where you are to where you would be if you refinanced.
Okay.
And then the cost to do that. So if you were buying down your rate, so we can go through your scenario right now, or we can wait if you want. But
the question, I guess, to lead us into this, why would somebody want to refinance? Like, what are the main objectives for somebody doing a refinance?
Yeah, the main objectives that we're seeing right now is definitely debt consolidation. You know, people getting too high on those consumer rates. Consumer rates and loans are at an all-time high historically. So I think a lot of people are using their equity that they've gotten over the last 5 years and trying to do something with it. Home improvements, or if you're trying to use it for investments, or also to lower your rate, right? A rate term refinance, you don't have to do cash out. There's the two, the rate term and the cash out.
So either you're just refinancing, getting a smaller payment, maybe getting PMI off your loan.
Yep, that's one too. If it's been a minute and values have increased, maybe your principal balance hasn't been dropping too much, but your value's gone up, you can refinance and get your PMI off. But you can also call your servicer and ask too, without doing a whole refinance too.
Right, and just get that off. As long as you can show, what is it, like
80%.
80%.
Yep,
Cool.
we won't drop it off. Like, we don't have to, the servicer. I don't say me personally. I'm not the bad guy, okay? The servicer doesn't have to drop the PMI until 78% loan to value. But you can call and request to have it valued, and as long as it's 80%, then they can. They still have a choice not to, but if it is, most likely they'll drop it for you.
That's crazy. So, I bet a lot of people listening, there's a handful of people that just that tip alone could save hundreds a month.
Oh, yeah.
On that. Right
for
there.
sure. Yeah. Even someone today that with a great credit that I was looking, their PMI with 15% down, their PMI is still $75 a month.
Yeah.
You know, so that's with 15% down. So imagine a first time home buyer with 3% that has that big gap. You know, over time, hopefully they'll be able to save quite a bit.
Well, yeah, let's jump into mine because I use mine as a scenario. So we bought a house. It was fall of 2024. And our rate was 7.1. I didn't go crazy like trying to buy down rate or anything like that because I was like, this isn't going to be my forever mortgage, right? And luckily we've been seeing things come down. But I'm like, when should I refinance? And my goal would be to bring down my payment because right now we're paying $5,600 a month as our payment.
Yep.
So I asked Shelby to come on and run some numbers, and I think this will be beneficial for a lot of people right now. So let's walk through my scenario and you can kind of advise me.
For sure. So just off the estimate that you gave me, and this is a big thing to keep in mind too, what you really want to look at when you're shopping for refinances and if it's worth it to you or not is strictly really the lender fees, right?
Okay.
Because no matter what, you're going to be replacing your escrow account from your current servicer to the new servicer.
Yeah.
So usually what will happen is when you pay off your first loan, then they will do an escrow reimbursement. So you'll get a check in the mail from your escrow account, but you're going to be establishing a new escrow account at closing costs.
Yeah.
So that's my biggest tidbit is really when you're shopping for refinance is the rate that you're getting and then also the fee to get the rate. Okay. So still kind of similar to a purchase, right?
Yeah.
But with you and like I pulled today, I pulled a not 7, that would be awful.
Yeah.
A 5.75% for a 1 point buy down for your refinance.
Okay.
So, and that's all based off of loan amount, right? So 1 discount point. So it essentially take you, $7,400 to get that rate,
Yeah.
right? But a no cost rate, so if you were to save your $7,400, it was 6%
Okay.
for that, okay? The difference in your monthly payment was $71. So you think about that.
From the 575 to the
to
6.
the 6, correct.
Okay. That's
Yeah.
nothing.
Right?
That
So if you-
$7,400 could
Yeah.
make that difference up for
100%.
10 years. Yeah.
Exactly. So the break even, how you calculate it, right? $7,400 is the cost for that, for the rate buy down. I'm not even including closing costs or anything like
Just
that.
keep
But
it simple.
I got that $71 from the monthly payment. Does that make sense?
Yeah.
Which I upped your loan amount from the original estimate you sent me, your principal balance, because I'm wrapping the fees in.
Okay.
Okay.
Yeah.
You can pay the fees out of pocket if you want, because then you're
Yeah.
not technically adding any principal balance to your loan and costing you more money. But if you don't want to spend that out of pocket, then that's an option if your loan to value is there. So essentially, you take that monthly difference and then the fee that it would cost you to buy down your rate. So in this case, 7,400 divided by 71, that's 104 months. Then divide that by 12, that's 8.6 years as the break even point.
Wow.
So what is the chances that you're either going to not be in this home or you're going to refinance again in 8.6 years,
Yeah.
right? 8.5 years.
Yeah.
So that's kind of how we calculate it. Is it worth it? In my opinion, I'd say take the no cost rate, do the 6%, save
Yeah.
yourself $7,400, but that's essentially how you would calculate that break even point.
And that $7,400 to buy it down at the start, that number fluctuates as well on predictions, right? So
Yeah.
next month, that could, same 0.25% or 1 point, could cost $3,500 depending on the futures.
100%. Yep.
Okay.
And it's never just this scale of my rate's 5.75 and it costs this, but if I go down 0.25% in rate, it's going to cost me 0.25% less in fees. That's not the case. Every investor has different pricing sheets, different margins, different lock agreements. So it really just depends on the investor we're working with and then also the time. Yeah, live pricing. So
Okay.
that's a good question. So yeah, next month you could get the same rate for half the cost potentially, right?
Yeah.
So what does that do to his monthly from that 7,1.4 or 7,125 to a 6%?
So monthly payment, and I have your escrow account included in this. So property taxes and homeowners, it was almost $5,100. It's like $5,098.
So right now I could refinance and save $550 a month.
Yeah, let's do it.
Yeah.
I don't know what else you want.
Yeah, we're done. Let's go. Yeah, and that's potentially that's what you could do, and that's what you have to ask yourself, right? So we do all
Yeah.
this math and we
So
talk
what-
about all that.
What should I be asking myself? Because that seems pretty awesome.
What's your end goal in life?
Right. Yeah. Where am I going?
Yeah.
Those are Ben questions.
Who do you want to be when you grow up?
I don't know. I don't want to grow up.
But
Oh, man.
yeah, that's all. And you think, okay, you can look at all the costs and things and say, okay, if I did this, then I'd be saving $5,500 a month. Do you have something else that you would want to do, right, with other investments? Or you could refinance and keep your payment the same and do a principal reduction amount every month of that $550 and pay your principal off sooner.
Oh, interesting.
So it would re-amortize so you could pay it off sooner. So if you're used to that payment, you could do that, but then
Just
you can
keep
pay
it
extra
higher.
principal every
Yeah.
month.
Yeah, that makes sense.
But again, how long are you going to be in the home, and is that
Right.
worth it, to you? So
So, and then the cash. So, like, let's say I did the 6% one. Mm-hmm. My payment is $5,100.
yep,
Versus if the other one was $74 cheaper, basically, but
Yep.
is going to cost a fair amount more. So, the cost of this alone, total cost, is that the $11,500?
that's right.
And so,
But those are just closing costs.
okay.
So the 6%, the closing cost is that $11,500, and that's establishing your escrow account, the title fees, appraisal, miscellaneous, all of those fees. But if you see on the lender fees, right? So you have like your prepaid items, your total closing costs, and then your credits on that 6%. $7,300 is credited to you. And I lowered your loan amount because technically I don't need to go that much higher if I'm not buying down your rate and wrapping it into your loan. Does that make sense? So it's a few $1,000s cheaper on your loan amount. And on a rate term refinance, you can get up to $2,000. Actually, Fannie Mae just changed it. You can get up to $5,000 in cash back without it being a no cash out refinance.
oh, really?
So that negative number,
I didn't know that.
So that negative number is actually cash back to you at closing.
Interesting.
Yeah, but that's why your loan amount's a little different, because in the 5.75, I was buying down your rate and wrapping it into your loan amount.
Yeah.
Yeah. So, but
Are you understanding all
Oh
that?
yeah, I'm gliding with it, but here's I guess the overall for people who don't speak lender.
Yeah.
Because it is a language, and Shelby is super passionate.
She's
and
great.
super educated. But it's hard sometimes. You have to dumb it down for guys like me. But basically, what she's saying is the fees. She's only wrapping it in on the 5.75%, but on the 6%, she's giving you the credit of the 7,300.
That's
Are we going
right.
to show this? Are people going to be able to follow this?
I mean, we could put it up there, yeah.
Yeah.
So what is this costing me? Like, let's say I wanted to pay out of pocket. I don't want it to be wrapped in.
So your closing costs, because I give
Yeah.
you that credit for the 7,300 for the I wouldn't be buying down the point,
Right.
so it's a free origination. So out of pocket, you would be like 11,549. So
Okay.
the closing cost is what you'd be responsible for, and those are all third party fees. So
Right.
my lender fees are basically non-existent for the rate that we chose.
Okay.
So that's to reestablish, like I said, your escrow account. These are your prepaid items, homeowners insurance policy, all that fun stuff, title work.
That $11,000, a big chunk of it is yours. You just have to pay a year's worth of taxes, a
Yep.
year's worth of insurance. That's not money that Shelby or even third-party people are taking.
Yeah.
Right.
A big chunk of that is you're putting that in your escrows.
Yeah, and if you think about it, remember what I mentioned? You're getting a reimbursement from your current servicer, so you could look at your current. I don't know if
Escrow.
you see what your escrow balance is. I don't know if it has it on
I
there,
don't think it has it
but
right
you could
here.
minus that from the 11,000. That's
yeah,
your true
20
cost.
Because it's going to come over.
2,500.
Exactly. Yep. So,
So
you'll
there's-
get a check in the mail for that.
So 2,500. So this would really be $9,000.
Yeah.
So $9,000, and I'm saving $550. So it really within
How long do you have to have that $500, $550 a month to pay off that $9,000?
yeah. So
Yeah.
less than 2 years.
Yeah,
Yep.
because you'd be $6,000 a year.
There you
Less
go.
than 2 years. So the only thing that would be holding me back from just jumping on this right now is, are things going to get slightly more advantageous in the next few months? Because this is
Right.
going to happen eventually. It's just,
Well, think about this. You're saving $6,000 a year in your payments right now. If you make that higher payment, you're spending an extra $6,000 a year. So, yes, it might, in my opinion, it might get a little better than 6. We might settle to that 5.8, 5.75, but you're only going to save monthly difference $71.
Exactly.
So
So
it's
if you wait for
$71
that
a month.
quarter
Why-
percent,
yeah, you're $500 a month
yeah, I see what you're
by
saying.
waiting.
Yeah.
Or
Yeah, you're saying you're already over a full
Yeah.
percent
you
in
you
savings
Yep.
at the cost. So in a way that could be good enough to just refinance now. Because if
Essentially,
you
Could be.
wait,
if you wait 1 month, that's going to take you
I'm
an
paying
extra.
I'm paying $550 more than I would
correct.
to
save.
try and save $70
Exactly.
or something.
exactly.
Every month you wait, you're spending
Shelby's
$500
loving
more.
it.
Yeah, I am.
It's
I'm
like our light bulbs
I'm
are
like, you
clicking.
guys are getting it. I'm like, oh my gosh, I'm
yeah.
so proud. Yeah, but I love how you calculated the other break-even point, because there is another way to look at it, right? Because like you mentioned with the cost. So
Yeah.
I was, break even with the loan amount and the rate and the cost for the rate to break it down, and if you want to buy it down. But then to Ben's point too, there is that break even of the full cost and closing costs if it's worth it. Because in 2 years, are you going to do this again and then have to pay another $9,000? Or are you just
Right.
going to sell it, right? So
Yeah.
And I think that's the question. The holding, how long am I going to hold this? If I'm going to hold
Right.
it 1 year, might not be worth it. If I'm going to hold it 10 years, well, yeah,
Well,
it'd be worth it, right?
definitely worth it. Or
Yeah.
even 2 years.
We are definitely going to hold on to it for a while. And the other question I had is, let's say I'd been into this loan for 5 or 6 years or maybe 8 years. Like, is there a point in time where even if you have like a big spread
good
in
question.
interest rates, where you're already that far into the
Amortization.
the AM schedule, where it just makes sense to stay where you're at because you've already paid a good chunk of the interest already up front?
Right. And
When's
that's
that?
another thing too, when people talk about it, restarting the clock 30 years.
Right.
Do you really want to do that?
Yeah.
So that's when I would say, okay, let's look at a 20-year term potentially.
Okay.
Or let's look at a 15, 10, depending
Yeah.
on what your debt to income ratio can hold. But if you did the refinance, if you wanted the lower rate, we could also do an amortization schedule as if you had a 30 or a 20 2-year loan, right? And so I could tell you, even though we reset the clock back 30 years, you could re-amortize it where you're paying more principal, but then you'd still be paying that interest up front. So it's kind of, I feel, sixes at that point. So if you're already into it quite a bit, you don't need to, I would just refinance with the shorter term so you're not paying more interest.
More interest.
And
So here's a good question on that. Mm-hmm. If I'm not worried about my monthly payment, because that's, let's be honest, 80 to 90% of the people's worry is the monthly payment.
right.
If I'm not worried about that and I'm worried strictly on my amortization, is there a time, a period in a 30-year loan where that switch becomes overbearing, or like, is it 5 years, 10 years? At what point does my interest and my principal start changing, or does it vary for every loan?
I would say it's probably going to be pretty close to the same, but if you just pull out like an amortization calculator, you could do this. So I did a loan amount of $500,000 at 6% for 30 years. If I look at the amortization schedule, like month 1, the interest is $2,500 and your principal payments only $497.
Yeah.
So you go down, let's go all the way to like when we're about halfway. You're going to be making about half interest and half principal, probably pretty close to, I'm still not there. Oh, month like 222. Your 222 month of your payment is about the same of interest and principal. Yeah.
So it's a little bit farther down there before you start seeing a real big change.
Yeah,
in that
so
on the
222
start over.
divided by 12, that's 18 years. So a little over half of the life of your loan to when you start 50% interest, 50%
So
principal.
you got to be into your loan really like 15 years or so, half of it before
It's not,
it
worth,
starts.
especially on one like yours, it's a little more than 500,000, but you're saving $500 a month,
550.
$550. I mean, that's a big difference from.
Yeah.
Yeah,
So.
for sure. So
And,
just,
and like I said, and if you're not caring about your payment, like Shelby was saying,
Just pay more.
keep that same exact payment, but make 500 extra towards principal, and it'll rapid amortization schedule.
for sure. Because right now, I mean, how much are you paying in interest per month?
Oh,
on
it's
your
crazy.
Yeah.
I got the taxing back and it was insane.
Did you want to cry? When I saw that, my heart hurt a little.
Yeah. No, it was
Yeah.
crazy when they sent the tax, like how much interest I paid last year. I'm like, good heavens. And it was like it was like 50 or 60 grand in
Interest.
interest only.
Mm-hmm.
And then the principal was like $4,000.
$9. Yeah.
I'm like,
You're like,
Yeah.
yeah.
I'm like, what?
That's so funny.
I'm like, that's a 7% rate. Cause I have other rental properties. They're a lot lower than that. And it's like, anyways,
Yeah,
those
not
were,
too bad
those
on
were
the
a lot,
interest.
those were a lot better to look at. This one, I was like, wow, it really makes a big difference. The
does.
higher rates.
Yeah. And if your interest rate's lower, so you're paying less interest, but then you also take that $550 and put it towards principal. Every month, your principal reduction goes down, so the interest that's being charged on that is lower. So it's hitting 2 birds with 1 stone, essentially. So it is a good strategy if it works.
So what if I was like, I want to do a 15 or a 20 year here? What would you say?
I would say if your debt to income ratio can handle it and you want to do it, let's do it.
So what would it do as far as my rate? Would I get that much better of a rate on, say,
Sometimes.
a 15 or a 20?
Yeah, sometimes. But sometimes the different investors, depending on the appetite for that, because all of the times if rates are changing in a not super great way, because servicers and investors want high rates because they want those big interest payments for servicing the loans, right? So depending on where that's at, it may not be that big of a difference for a 15 and a 30. Usually we can see about 1/4 to 1/2% difference, but I wouldn't say it's
Quarter
much
to
more
a
than
half,
that.
but your payment goes up significantly.
It does, but you're also paying a lot more towards principal, right? Because
Yeah.
your amortization is shorter. But the rate difference is a lot less than people think.
Yeah.
And sometimes it's more, which is like nuts.
That's crazy.
Yes.
Just because they're like, this isn't the actual servicers going, I'm making less money on this. Why would I?
Yeah, I don't want to incentivize them to do that. Yeah, it doesn't happen very often, but every once in a while when I price it out, I'm like, oh. So then we'll say we'll just do a 30-year, but then do a principal reduction amount every month if 30 years lower than the 15. Yeah, but again, that's not very common.
Well, and the nice thing about doing the 30-year is your payments are going to be a lot more manageable. You can pay it off at a 15-year if you want to. And then if you're trying to buy Christmas presents, like that month you don't,
Exactly.
and it gives you more flexibility versus if you go for the 15-year, you're locked in at that. And you just have to weigh out, is that lower interest rate worth the extra monthly stress?
Is that worth the self-control I'm going to have to not spend every cent I'm not spending on bills?
Right.
Exactly. Because you can do a principal reduction amount anytime you want. But you have to be careful because just increasing your payment every month does not mean you're making a principal reduction amount, because the servicer will hold your payment and your overage and they'll apply it to the next payment. So if your payment is, you're $5,100 and you're paying $6,000 a month or whatever you want to do, you have to specify in your monthly payment that you want it to go to principal reduction, or it won't do what you want it to do.
They'll just apply it to
They'll just apply it to the next payment, and they'll just kind of keep a little bucket for your payments.
That's crazy.
Yep. So you got to be careful.
So the only other thing that would be like extra home run here is if I had PMI on this too, right? Because you would basically in the refinance, we would see if how would you calculate if you, like on the next loan that you're refinancing, if you wouldn't have PMI on this? Would it be strictly on the appraisal?
Yeah, if we had to do an appraisal, if the value is so high, like say if you only owed a couple $100,000 and your value was, 1.5 million or whatever, sometimes our automated desktop system for underwriting give us an appraisal waiver, because it's like, okay, well, just based off the value, you're good. Yeah. But if it's not and it's pretty close and we run that desktop underwriting system, a lot of the times it doesn't give us an appraisal waiver.
Yeah.
So at that time, we're like, we need an appraisal because of the guidelines and the underwriting guidelines. We would have to have an appraisal to meet the condition. So once we order it, yes, to answer your question, the PMI falling off is dependent on what the appraisal comes back at, because we have to have 80% or lower to get rid of that PMI. And you can do a refinance and get PMI put back on. Because, for example, say if you started in your first-time home buyer and your credit's awful, because PMI goes off of your down payment and also your credit too. So say if you're just in a rough spot, and really bad credit, but then you were able to refinance, your loan to value is a little bit better and you have better credit, it could still be beneficial.
Yeah.
Even though you still have PMI.
Because I've seen PMIs up $225, $300 a month.
Oh, yeah. Oh, yeah. 300 is not out of the ordinary.
And it was because they barely squeaked by on credit, and they had, I would almost say, a toenail short of 3% down.
Right.
So, refi, even though you're not getting rid of PMI,
could make it better. Exactly.
And can you, so say I'm that guy, can I go, hey, Shelby, can you see what my PMI would be? Can you calculate that before I pull any triggers?
We sure can. Yeah. When we pull up rates, we have a whole MI. We shop like 8 to 9 different companies for mortgage insurance. So, yep, we could tell you what that would be.
Let's say they bought the house, and when they bought it, it was $500,000. They put like 5% down. So what's that? 25 grand. And then they do a refinance, and it comes back at like, I don't know, 550 or something like that. So then they have their down payment of what they put down plus an extra 50 grand. Could they come up with the extra cash? Let's say they had some reserves or something to put down to get out of PMI on the refinance?
You sure can.
That's
yep.
cool.
A lot of people do that too.
Yeah.
If they're like, you know what, I'm going to be getting this inheritance, or I'm going to sell my house. So maybe they'll just try to, this is a perfect example. I have one closing at the end of this month. They're buying a new build, but they're waiting for their home to sell. And so they're like, well, we only have this much cash. So we're going to suck it up and do the PMI thing for a minute. But once that home sells, and if rates go down, then we'll sell and then we'll refinance and put a principal reduction amount, get rid of PMI, get a lower rate, all that fun stuff. Or you could just recast it. So a lot of servicers will let you just recast it, keep your rate, keep your terms, everything like that. They'll just reduce your principal amount, and that will be your new payment.
When you recast, does that reset amortization as well?
No, it goes off of your current amortization, current terms. So exactly everything that you signed on that promissory note, the deed, everything, and then just a principal reduction, it just re-amortizes based off that new principal balance. Yeah, so if you had 2 years into it, so you still have 28 years left, it would re-amortize based off of 28 years.
For how long will most lenders let you recast for? Is there a certain time frame?
My servicer at Glacier is awesome, and they'll let you do it as many times as you want for free.
Really?
Well, yeah, but a lot of servicers aren't like that.
Wow.
They charge a little fee, or you can only do it one time a year or one time every 5 years, or it just depends. So that's why when people ask me, and I know that that's the plan, I don't know if their loan's going to get sold or who to, so I usually try to keep it. the
I
servicing.
see.
Yeah. So it's good to know that intent and to get to know what their plan is so that we can strategize that way.
How much, like, at what point, how much money makes it be a recast versus just like, hey, I'm just paying extra money towards principal or whatever?
You
you
can
know?
put anything you want. If it was
So if I got
$10,000,
$1,000 for my
Yeah.
birthday and I say, Shelby, you got my
recast is
Recast
baby.
it.
Yeah.
Really? That's crazy.
Yeah, it is
I
crazy.
thought there was like a set number. Or
A
something.
minimum,
Yeah.
yeah. And some servicers may have a minimum. As far as I know, we do not, but that would get really tedious. And I know it's just a quick change in terms sheet. Like that's usually what it is, just change in terms for your amortization schedule. But it's not a change in terms to your rate or, your original promissory note that you did.
And just to clarify, hey, we're talking recast, we're talking lender terms again. Mm-hmm. Say I got an extra $10,000 or whatever, and I say, hey, I want my $2,000 a month. Well, let's be more realistic. $4,000 a month house payment. Here's $20,000 to recast. Mm-hmm. What changes for me? What differences am I going to see monthly? Is that a payment goes down? What happens there?
Yep, that would be your payment that went down. So if we want to just do some fun math,
That's a good question.
it is a good question. So let's say that you started with 500,000 or 6%. We're just going to, this is a good
Perfect.
scenario. So let's say we recast it, boom, we're at 480. Oh, let's do 500 again.
I gave you $20,000 to recast
20
my
grand to
$500,000
recast
loan.
it. So your principal amount you're paying, let's just round it to 500 a month right now. That's it, 500,000 at 6%, okay?
Okay.
So 500 a month towards principal. Let's do 480 now. So we recast it, boom. Now we're paying 400 and no, that doesn't make sense because it went down. Hold on. The principal went down. It should have gone up though because you should be making more principal.
Because it doesn't restart the 30-year. It starts it basically reworks the monthly breakdown
Right.
of your
Yeah.
principal and interest from the day. So you're not repaying that heavy, what you were worried about, that heavy interest up front on the loan.
So it's like I could recast this loan would be me paying like $50,000 towards it, and then my payment would be like $5,600 instead of $5,643, something like that.
Right. So $20,000 reduction in principal only makes a difference of like $25 a month if you were to re-amortize that whole thing.
Oh wow!
So really, if you have $20,000, you might even just be worth it investing it somewhere, right?
Okay.
Instead of getting your principal balance down, because $25 a month probably is not going to do too much for you, savings wise in your pocket. But
Right.
if that's what you wanted to do, you could do it.
Interesting.
And now, is other than the monthly benefit, is it better to, I got $20,000, can I just dump it right on my principal as a principal payment?
Yeah.
Does that help me over the long run better than a recast? Or
I
is
would
it-
say so, because if you're just getting that principal reduction down, then immediately that's the interest. Well, it's kind of the same, because if you're recasting it and it's the same principal reduction and your payment changes, then you're making a little bit less interest every month, right? But if you do principal reduction, the interest that you're being charged is less on the principal balance, but your payment wouldn't change. Does that make
Yep,
sense? So your payment would stay the same, but then you'd have a principal reduction. So yeah, so I think it's probably going to be pretty similar.
where you want to see it, either in your payment or in your principal reduction.
Exactly, exactly. Yep, and paying your loan off sooner, or do you want to keep the terms that you have and then just pay it off at the end of the
Because I'm
term?
more worried about my monthly to my term.
Right.
So if say I got 200,000, I wanted to pay this down, apply it on here. I could choose not to recast it. I put it all towards principal, and then I would, in essence, pay this off quicker because I paid it down, but I'm still paying the higher monthly rate, right?
That's right.
Okay.
Or if you have $200K ready to go, refinance, get your rate down, and put the $200,000 down.
Yeah.
Yeah.
Pile it all on there. Do it.
Well, and a lot of people, that's kind of what they wait for instead of
Yeah.
recasting. They go, I'm going to couple this
Yeah.
with my, because I'm going to lower my monthly. I'm going to, essentially, the term will be longer because you're renewing your term, but your monthly is way lower. So then you can just keep
Yeah.
making that same
It,
payment
Yeah, it's like this. It'd take me less than 2 years to get this
back.
back.
Yep.
Yeah.
Exactly.
I think there's a lot of people sitting in that situation where,
I think every single person, just like you, everybody's situation is different.
yeah.
And you really got to just get on the phone with Shelby and go through what your needs are.
But anybody that's bought in the past 12 to 24 months, like probably has a rate in the high sixes, low sevens, and the yucks. Yep.
Yeah. 2022, people were locking in the 8s. Like there was some 8s up there.
Oh my gosh.
They probably refinanced sometime last year when rates started to come down a little bit, but they're still out there if they don't really know what's going on. But yeah, and I will say this last thing that's been super interesting. A lot of elderly people, this is like, we have 4 loans in our pipeline right now with this exact situation. I know other people are going through it. But elderly people that are just off of Social Security right now that maybe have a little bit of a loan, but they have hundreds of $1,000s worth of equity, but they have a really small income, they can't access the equity because they can't afford the monthly payment to get the equity position. Does that make sense?
Yeah.
So a lot of people are trying to refinance to debt consolidate. And so it's great product to have to do a refinance to debt consolidate. But we're finding that a lot of people on those fixed incomes can't make it. They can't do it, and they have $800,000 worth of equity in their homes. So
That's
then
crazy.
they have to sell. They have to sell.
move.
Yep. Yeah.
That's wild.
Isn't that heartbreaking?
Yeah.
It's really hard. So, yeah, but we're seeing it a lot right now. So it's a great thing to have. But yeah, it's just interesting how the economy and the values can be so beneficial. But you have to make money to access your equity that you got unless you sell it.
The hard part is like, because I remember doing like payments consistently were like $1,000 to $2,000 for a while, you know, and then they jumped up to $2,000 to $3,000, and now they're in between $3,000 and $4,000 on average. Like most first-time home buyers, I think the average payment in this past year was like $3,600 a month or something.
Sounds
like
exactly right. Yep.
And it's just so much money.
Yeah.
You sound like such an old man.
Yeah. You
Oh,
talk
back in my day when it
I
was
know.
$1,200 a month.
Yeah, well, you're the one with the cheap. I only have 2%.
Listen, this will make you feel
interest
better.
rates.
In 2019, when I bought my first house for $230,000, our payment was like $1,100 a month.
Oh, yeah.
Yeah, not even that long ago.
And not even with elderly people. You talk about there's like, I'm in the same situation. I have all this untapped equity. And I go to the bank and I go, hey, I make this much a year, but I have, let's say, call it $1 million in equity between these properties. And they're like, cool, you can't have any money because you can't technically qualify for the higher payment, even though we're going to give you $300,000.
Right.
You can't use that as a payment maker upper.
Yeah.
Like,
It happens.
so it's you got to really stay on top of and know your stuff,
Yep,
Yeah.
or
for
have
sure.
a Shelby.
Or
Hey,
have a Shelby.
I'm always here for you. I got you. Yeah.
Well, is there anything else that we should cover while we have you on here? Or do you think we covered it all pretty
I
good?
think we did. Well, I think we killed it.
You
Honestly.
answered all my questions that I had. So
Good. Ben,
I
do you have
think
anything more?
The only thing I will say to everyone out there is, and I beat this into, I can run through scenarios with people, but if you really want to like I can, just like me and you, we talked about, we wrote some numbers down. Oh, that's great. You want it to be real? Call Shelby.
yeah,
Actually have that conversation. You don't have to have a loan that day, or maybe it's 2 years, or maybe it's you're just planning and you want to talk to her.
Yep.
Call her.
Yep.
no, just get a plan in place.
Exactly.
You don't. It does, just because you call her doesn't mean you're committing and you have to refinance that day. Right?
Exactly. And I can run scenarios left and right, and we can do it. I always tell people the worst thing that would happen to you is your credit was pulled. If you decided to not do anything at all, your credit was pulled. And a lender pulling your credit for a mortgage is not anywhere near what it is like if you were getting a car or a credit card or something like that. You'll see minimum, if not any, damage to your credit score.
Yeah.
But we can run scenarios like we can beat a dead horse with that. You know, like it's just we could do a lot.
Can you run scenarios without pulling someone's credit?
Yes, of course. Of course. But I always tell people we take a tri-merge credit report. We take the mid-score of the lowest borrower. So what's your credit score? And if people pull up on their credit union or their bank and they have that one score, your scores can range by 80, 100 points between the three bureaus, right? So I always run it with 3 different credit scores because there's those different tiers.
Yeah.
Like if we were immaculate credit, this is what we would be looking at. If we weren't, and if we were around, this range, then this is what we'd be looking at. So at least they have the worst case scenario, and then they can still decide if they want to do it or not. Yep. And you still want to shop for a refinance. Like, my rates and fees are what they are. Other lenders are what they are. And, I want to mention what was on your Penny Mac letter.
Oh, yeah.
Because a lot of that rate media, they'll say, we could get you a 5.5% rate, but they don't anywhere on there say how much they're charging for that, right? Because it's all dependent per person, right? Yep. So they're like, oh, we can refinance you 5.5% rate. But how much does it cost to get there?
I tell you, you have a good lender when they aren't afraid to tell you to go shop. And two, and maybe you like this or you don't, if somebody's already shopped another lender and they bring you and say, hey, help me decipher what this quote means. Like, it looks better than yours. Is it? Don't be afraid to be like, hey, I want you to tell me, Shelby, what's on these papers. That's huge.
I shouldn't admit this, but I do that so much because I get the loyalty, right? Like you start with a lender, you're so far down the path of the lender. And sometimes certain lenders don't explain things the way that connects with you, right? But you could be 3/4 of the way done with your process. And I respect that. And I wouldn't want to be like, well, I'm not going to help you if you don't come over here. That's not, if that was how I was, I wouldn't be a good lender. My sole purpose is that people are educated and they understand what they're getting into, because it's a lot of money to deal with. So I have that very often, especially with new builds and their lenders where they're just pumping loans out like crazy. I have so many people, even though I can't touch what they're offering, I will still sit with them and go over everything with them so that they still feel that confidence. And a lot of people, it's like that bank with us or that know me personally, they're like, oh, I want to use you. And I'm like, dude, I can't touch that. So I can't match it, but I will still go through everything with you. So I will always be that person if you need, even if you don't end up using me. But I definitely think you need to have someone on your side that can educate you and make it make sense. So.
When I think after having that conversation with you, even if the time doesn't make sense now, then I think you would be aware of like, oh, well, 6% interest rate doesn't make sense, but when it gets to 5.5 or 5 3/4, then let's run with it,
Right.
And then you just have to watch,
Exactly. And I have that watch list. I'm like,
Do
hey,
you?
when rates go down, I'm going to be making some calls. I'm sure a lot of people do. But, you just have a reminder. You just pull up their scenario, see where they're at, and say, hey, you said a while ago 550 wasn't your number to save every month, but now I'm at 650. So what do you think about that?
Yeah. Yeah. No, that's awesome.
Yep.
Well, this has been super helpful. I've been wanting to do this one for a while now. And thank you for coming on. That was awesome.
Thank you.
It's been all right.
Yeah. It's always a joy.
So if you guys need anything when it comes to loans and houses and mortgages, call Shelby. She's your gal. So
we'll have a good time.
thanks, guys.
Love you. Bye.